trader, because in a breakout, you want it to continue. All right. Once it gets through, you want more buyers. You want volatility to pick up. An approaches trader, he wants to see volatility start to decline, because the approach, there was high volatility, and then it stopped at a resistance point. Now he wants to see the market collapse back down. So if you're approaching a market, and you're looking for a swing, and you're looking to sell into a level, then you want that volatility to stop. If the volatility stays strong, it's gonna pop through. So I guess you can build a case that it is your friend, because you know what? If a friend's supposed to help you out, then high volatility as a market's approaching, it's going to be your friend to tell you don't step in front of this trade. So I guess I can build a case for that. All right. And breakouts are usually associated with volatility. All right. Here's some more things to look at. Don't be worried about. Here's the characteristics, first of all, of horizontal line trading or key levels trading. Is you're going to get approaches like this, and then you're going to get some pullbacks, and then you can see all the green, and you're going to get these little penetrations. Okay. Then you're going to get the pullbacks back through it. So you're going to get moves where maybe you'll take a breakout, and you don't have to risk all the way down to here to know that you're wrong. If this is your area of interest or your entry point, okay, you're going to want to see volatility on a breakout. So if you're taking a breakout here, say you have a stop order in and you're just buying at the market as it breaks out, if the momentum stops, and you'll see if it spikes up like this on the candlestick, and then a body starts to come down, that's one of the first clues that the buyers are starting to get out. So again, watch your time periods. If this is a 15-minute chart, the shorter time period that you trade, you're automatically telling the market, I'm willing to take a lot of small losses to catch a big move. That's what trading small time periods is saying. You're going to get a trading profile that shows maybe a 50-50 trading methodology, but you're also going to get smaller losses relative to your wins. So you sacrifice one over the other. The longer term time periods tend to have lower percentages, but they tend to have bigger average wins. There's all kinds of trade-offs in the market depending on how you choose. So when you're trading momentum and volatility stops, or when you see one of these wicks go up here, that's the first clue it's going to come back down. Now you always have the option to treat this horizontal as a pivot price. Buy above it, sell below it. That type of philosophy. So you want to notice that here's where the breakout failed. Here's where a breakout failed, but then it picked up the trend once it went underneath. Usually when you break a line, you're going to get a test and a retest. Here's where it was great resistance. You know, it formed good resistance. Then finally, when it broke through, notice that on the breakthrough, what happened here? When it broke through here, it fell back below it. When you see it break out here, there was minimal penetration back down. Then finally, when it broke out again, you could see it tested it exactly. That's the law of support and resistance. That old resistance will eventually become new support. So all of this trading action that takes place, you're not killing yourself going after the market as it approaches this line, but eventually you're willing to sacrifice a series of small losses to catch a big move. So you have to be flexible depending on your strategy, that sometimes to use this as a breakout, other times to use it as resistance, and then other times to treat it as a support price once it breaks, and then you can catch that big move. That's just how markets work. You get sideways, chop, chop, big move. And you have to be capitalized enough to take advantage of it, and you have to use the stops. Now, you also remember to use the stops and protect yourself, because if you continue to sell into this thinking it's going to come back down and you get one of these, well, then your account's wiped out. So you have to use stops. All right, so that's the characteristics of it. Small losses are part of trading. It's the cost of doing business. And oftentimes, it's indicative of a bigger move coming. All right, I'll go through this here. When you're going to use technical tools in conjunction and combination with the key levels, remember horizontal lines are what the key levels are, the horizontal lines. So they're showing you a flat line. All right, so you want to show some movement, so you want to throw a trend line in there, or something that has diagonal movement, something that's showing higher tops, higher bottoms. You want to have Gann angles that can help out. You can also use retracement levels, so you can double up. If Autochartist has one horizontal key level, then you can go to another horizontal key level, and that is retracement lines. You can use floor trader pivots. You can use Autochartist chart patterns, triangles in particular with these levels, and you can use the fib patterns. All right, now you can also use, like I said, you're going to work with horizontals, diagonals, anything that has a look forward indication like a Fibonacci. Our Fibonacci tools give you a look forward. And there's also some momentum indicators and oscillators, which I'm not a big fan of because they tend to lag the market. All right. You can use true volatility to help you, either increasing or decreasing. I don't use momentum that comes with many chart programs because all it is taking today's close minus the close 14 days ago. That doesn't tell me anything. You can use average range, or you can use average true range to give you indications of it. Also, pay attention to volume. Rising volume equals rising prices. Those things go together. Falling volume, falling prices. You can get rising volume and falling prices. Know what's happening if you're looking at conditions that are going on here. If you're bullish, you want to see volume going up. If you're bearish, you want to see that volume may go up as the market's going down, but you could also see sometimes markets go down because volume is decreasing. Traders are just getting out of the market. So pay attention to that. Pay attention to open interest if you're trading futures contracts. If you see open interest up and prices go up, you know that new longs are coming in here. If you've got a bullish breakout coming, or you're at support, you want to look to see if this is happening. You want to see that open interest is going up and prices going down, and you're at resistance. That means that shorts are coming in. So there's little clues that are outside the chart pattern that can help you. Also trade when there's activity, like trade the opening. Trade after lunch. After about an hour or two of the opening, if you're trading currencies, trade the overlap in the morning. London, Europe, US. Get out after Europe closes and wait again for the afternoon, after New York comes back from lunch and after Chicago comes back for lunch. In the middle, you tend to get chopped up. We call that mush time. All right. Also, learn to read a tape. That's old-fashioned. Read time and sales so you can see what's actually being traded. If you see a lot of one lots being traded, then you know it's little guys like me going back and forth with each other. If you start to see 10, 20, 50 lots being traded in, say, an S&P, an E-mini S&P, or some big shares being tossed around, that means that there's some big players in there and the action is real. Okay, learn to read bids and offers. That helps you. If you're going to see, like, for example, here, if you see that there's small amount on the offer, 13.97, and you see big trade on the bid, all right, this is a slowed down version. Of course, it moves faster. But if you see that there's an overwhelming amount of buyers and you're at a breakout, you're at a resistance or support point, that this could turn the market up. So this could help you as you approach, and vice versa. If you're approaching an Autochartist key level resistance, then you may want to look for more offers out there. You want to look at changes in thickness of the tape if you read the tape. If you see red and green, if you have a little bit of green versus a lot of red, that means there's sellers in there. If you want to see some of the size, if the size changes. So these are little things that can help you work with the horizontal levels. I will now go to some live data, and I have some time. It was pretty fast going through 40 charts. All right, and I have some time here. Good. So there, I was waiting for some of these alerts to go off. You can see that from this chart. As I said, I don't know if you traded the report, but you can see what happened here. You get whipped up, and you get whipped back down. So sometimes, what do we always say? Sometimes let the report come out. All right. Then what happened? All right. It gave you a breakout sense, and then it came back below it. Now, once it came back below this resistance point, what did it do? It went right back to it. You see right here? and then it started its decline again. All right? That's the kind of stuff that you want to watch. You can be a hero and jump in front of the numbers. And, the funny thing is, it's one of the most important numbers of the week. And I'm watching a TV show that's showing me a Harry Potter commercial 1 minute before this number comes out. And I'm thinking to myself, there's thousands of people waiting for this announcement, and I have to see that Harry Potter movie is going to be on during the Christmas holidays. So that's why maybe you want to wait for the number to come out, let the market settle. That's the soccer ball going back and forth. That's the little 6-year-old kicking a ball all over the place. And now the older kid here waits for the market to stabilize, and then he picks a direction. All right, so that's very important. This is a repetitive pattern. You'll see it on Fed Day. You'll see it on any of the central bank days where you're going to get activity going up and down, wait for it to settle. Who knows what's going on here? These are a lot of times what we call air moves, meaning that nothing is being put in, nothing is being, but the air is just getting sucked out of the market. And if anybody tells you they make money on these, then it was an error. It was a mistake usually. But once the market settles and it reestablishes, yes, this is resistance, okay? Yes, this is resistance. Now you get your direction change. So again, that line became valid after all this hoopla went on here. So that was really important. That's how the Forex worked. Now, if you're new to Autochartist, you'll see these orange buttons here. These things come up when there's new activity. So let me take a look here and see if some of these approaching markets took place. Okay, you can see this is a good example of how solid this support price was, and now it's coming back down. But look at the size of these candlesticks. Okay, so as it's coming down, if this starts to get stronger and stronger as it approaches this, what are you looking for? You're looking for some green to show up. If you continue to see red in the size of that, then the approaching, chances are it's going to go through it. So if you're going to be using this as support, let the market come down and settle, soccer ball again, and then wait for some green to show up. Okay, so Autochartist has told you right here, 104.65 is a big number. Also, if you're already short, say for example you use a chart pattern and it tells you to get short, you can always use this as an exit in addition to the other Autochartist indicators. All right, let's see if I can find, see what's going on in the euro. All right, right now, not a lot to say here because it's a 15-minute chart. The key is here is, again, that you can see in this chart, going back to the characteristics of the market, is that when you do get the breakouts, some people like to trade strength on a breakout, and what happens is you're first one in, but you give up the price. So you may be paying up, and if you use a stop, you may get some slippage. That's the trade-off. You're in, but it might cost you more. The other way to trade is to let the market turn blue. Let the market come down, reestablish support, and then put a limit order in. Well, what's the trade-off there? Well, number one, the market says, sure, you can do that. I'll let you control the price. I'll let you control where you get in. But guess what? I don't have to go down there. So there's a cost. If you want in, it's going to cost you a little bit more if you want in early. But if you want to wait for your price and wait for everything to be just right, boom, we may not let you in. So that's how the market, that's how you pay. You pay, you want the market to pay you, but sometimes you have to pay the market to get in, to be the first one in. And other times the market charges you to get the conditions just right for you. And the trade-off is you miss the market. Personally, I'm here to trade, so I'm going to use an indicator like Autochartist key levels because I want to trade. And what aggravates me more is I don't mind if I'm wrong, but I mind if I miss a good move. All right, that's my personality. You learn a lot about your personality when you do this, by the way. Let's see if anything's moving in the stock index because we had about a half hour, and then I'm going to have some questions. Let me go to another program here. This is these are stocks. Looking for some U.S. Indices since they just opened. All right, E-mini Dow. Good setup here on this particular breakout. No, nothing's coming in here. We're not getting good action yet. Just open. So I think I covered enough material to show you what's going on here. Market's not cooperating right now with these with the action because it's the market's just started trading. So things have got to fill in. The market's got to absorb this morning's number, and as well as events in Europe. So it may take a little bit. Maybe they're done for the week. Maybe because of Wednesday's big move that the shorts got blown out, so they're licking their wounds, and the longs are afraid to go in. So it's kind of a slow market right now. Here's let's see if anything's happening in the UK. Now all we're doing, it's very slow sideways. We're testing support right now. Again, you got red, 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 red dropping into this. So if this is going to be your exit, okay, remember, old tops, new bottoms, watch it, because if it's going to turn, not only is it resistance, but now it could become support. So watch for some green to show up. Don't be the first kid in the pool. You know, it could be something out there. Water could be cold. Sharks could be out there. So you want to wait for the market to stop and then turn around. Anyway, I'm talking too much. I will answer some questions right now before Yvette cuts me off. Right?
We've had some very good comments. People have really enjoyed your session today. Thanks, James.
It's
really, really
informative.
And we're going to get this recording up on our website.
6 cups of coffee and some 25% butterfat coffee ice cream. That's what fires me up.
Coming up.
If you ever come
We're
to
going to
Chicago,
have the recording on our
ice
website
cream
as soon as possible.
All right, I will see
Yes,
what
I know that.
questions are.
Okay, so we've got one question here from Mike Collier. He says, so you don't take along with the key level as TP?
Mike, I welcome you. You're here every week. What I look at the key, I remember I told you my trading philosophy is know my exit first. And you remember have to look at the definition of approaching, okay? It's not, and there's a really good video also from Eric on the program, is that there's a certain percentage, a certain boundary that the market could reach and consider to be a successful approach. Okay, so as what I'm looking at is that barrier is there. Now I'm watching the trading action going up into the barrier, knowing that if they cross to the other side of that barrier, I'm out. So I really want the market to kind of stop and start to make its turn in front of the barrier. If I'm using it as a swing approach, in other words, if I think the market, you know, the conditions are such that maybe it's turning at that level, I'm looking at it as an exit. Now, if I'm trading a breakout method, then I want to see the market go through it, okay? And then when it goes through it, I want to see that test of it to make sure that traders are now respecting this old resistance as support, and then I want to see the move go through. So I treat it not as a turning point if I'm a breakout trader, but since we're doing an approaches webinar today, I try to emphasize if I'm treating it as resistance, then I'm watching for anything, lower ticks on level 2, big offers on level 2, size coming in on the time and sales. I'm looking for you know, some kind of bearish candlestick pattern. I'm looking for red, and that tells me that traders are starting to get in, that they've respected this and they want to get short right now, and they're not going to wait for this level to get hit. So those are that's my kind of thought process that's going on. And I'll use it then as an exit in that case. All right? I hope that answers your question. Yeah, the approach area is the place to watch and wait, and then you remember it's just a horizontal line. It's just a point that it's an area of activity. All right. Now, if you have that there, and if you use, say, for example, you have a chart pattern that's got a line coming down in that same vicinity, then by all means, you know, use the combination of the two. So try to get a diagonal combined with a horizontal, and you got, you know, pretty much the dynamite setups there. It's either going to tell you it's an area of interest. It's either going to break out or it's going to go the other way. But the order flow kind of gives you a hint. All right, Dennis, sorry about your fatal error. So you can email us at the office, and we'll probably, our technical guys can tell you how to fix that error. All right. PK from India. Most ideal, you know, that's a personal preference question. I can just tell you the math behind it. All right. The shorter the time frame, the more trades you're gonna get. Okay. All right. If you can't handle small losses, don't trade small time frames. So to find ideal, it's whatever makes you comfortable. Okay, if you're going to get aggravated because you're getting false breakout, and you walk away from that machine, then don't trade that time period. That's the best answer, because I can tell you that you think about it, the smaller time frame, the more frequency of trades, and that, you know, you better have control over your costs, and you better have patience. So you got to find a time zone that's comfortable. Okay, that's the best way to answer it. Let me see here if there's another question.
I think if you could just answer Derek's question.
Oh, there it is.
James, if you just
scroll. And what parameters do you set Autochartist when trading on 4 hours for better result? For I understand candlesticks, Fibonacci very well. If you mean like the strength, I'm still working with the strength. I like to see a good bullpen of patterns, and then I tend to watch not necessarily how many touches of the pattern for my strength, but I look at the length of the particular pattern. I tend to want to look for longer time periods, because I want to make sure that a lot of eyes have seen that pattern. Because then when it does make a move or activity starts to break out or it starts to approach that level, they want to make sure a lot of eyes have had it. So I think the length of the pattern is more important to me right now than the strength of the line. Hope that answers your question there. And that's about it. Just remember, use stops. Keep your powder dry. If you can't read it, don't do it. Settle the ball. I sometimes think everything I learned about trading, I learned in kindergarten. Be nice to people. Say thank you. And so I want to thank you for attending today. Have a great weekend. Yvette?
Thank you, James, and then we'll see you back here next week. Thanks very much.
Not if I see you first.
Very good session. Thanks, James.
Bye-bye.
Great. Looking forward to it. Bye.